Last year on the S&P 500, we were up almost 27%. It's all gone. It's all gone. We're negative by 2.7% now on the S&P 500, wiping out last year's gains. On the Nasdaq 100, we're down 3%. That's the equity story. Bond market picture looks like this. Yields are still climbing, still breaking out on 10s. Your 10-year close to 350 earlier, 342.34, up 14 basis points. On a 2-year, up 7 basis points to about 326.72. Even with some weak data a little bit earlier this morning. That's the price action. Here's your trading diary. Another Bank of Japan rate decision coming up on Friday. That's going to be interesting. Plus, we'll hear from the Fed Chair, Jay Powell, too. More Fed speak from Governor Waller on Saturday. Next week, U.S. markets closed on Monday in observance of Juneteenth. And finally, a host of Fed speak throughout the week. Mester, Barkin, Powell, Evans and Harker all over again. Wow, what a couple of days we've still got to come through today and into tomorrow. This was the Countdown to the Open. Thank you for choosing Bloomberg TV. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Thursday, June 16th. Here are the top market stories we're following for you at this hour. Digesting 75 from stocks to bonds. Investors digesting the first 75 basis point rate hike since 1994. Can the economy handle it? We're going to get takes from Bridgewater's Greg Jensen and Orlando Bravo of Thoma Bravo. Central Bank Palooza. It's not just the Fed. The Bank of England raised rates, warning of bigger moves coming, while the Swiss National Bank surprised markets with the first interest rate hike in 15 years, front-running the ECB. And meeting Zelensky. Leaders of Germany, France, and Italy visit Ukraine today as the Kremlin tightens its grip on European energy markets, curbing gas shipments and stalling on a deal to export Ukrainian grain. From New York, I'm Kriti Gupta, in for Alex Steele. Guy Johnson is in London. Welcome to Bloomberg Markets. Guys, so much to digest here, but really at the core of it, it's those central bank decisions that are really moving the markets and moving them big.
I barely know where to begin. Let's take a look at what is happening here. You've got central banks raising rates, raising aggressively. The S&P coming out with a huge surprise earlier on, raising by 50 basis points, following on the Fed's 75 basis points. The Bank of England is out with 25 basis points, maybe a little bit more cautious. We come to the BOJ tomorrow. So much action in the central bank space. But then you think about what is happening in gas as well. UK gas prices are up by 100% nearly this week alone. We've just got a headline crossing on the Bloomberg terminal. US mortgage rates surging to 5.78. That's the biggest jump since 1987. It's fascinating to see that we are seeing a much bigger response in the mortgage market than we are, for instance, in the US 10s or 30s. So much to sort of factor in. And you wonder whether the market is capable of keeping up, whether actually pricing today is a realistic reflection of where risk really is. Let's try and answer that question. We've got the perfect person to answer it. Greg Jensen, Bridgewater Associates Co-Chief Investment Officer. He's the co-CIO of the world's biggest hedge funds. Greg, I can't think of a better person to ask that question. On a day like today too, we have financial markets in turmoil. Central banks are clearly racing to catch up. Do you think that pricing currently reflects risk?
Unfortunately, I think there's a fair amount more to go. We're in a secular process here that things have radically changed from where they were, let's say, pre-COVID. And you went through last year where asset prices were supported by a tremendous amount of liquidity despite deteriorating fundamentals in terms of the rapid pickup in inflation. This year, central banks are scrambling, as you're describing, to catch up with what happened last year. And there's two effects to that. There's the rising interest rate, which is being discounted across asset classes that have benefited from extremely low interest rates for so long. You're starting to see that come out of the markets. And on top of that, there's a liquidity hole that's developing. The liquidity hole is a function of, if you take last year, where did all the money come from to buy assets to keep them at high levels across all asset classes? That was a result of the Fed and banks piling into the bond market despite worse fundamentals. And that money, that 10, 11% of GDP that came from the Fed and from US banks, filtered all through financial markets, essentially sustaining assets that require new liquidity to keep their prices. Now that the new liquidity is going the opposite direction, banks are no longer buying bonds. In fact, they're likely selling them. The Fed, of course, is moving towards rolling down its balance sheet. So now we're finding out at what level the private sector by itself can support these assets. And from our calculations, it would suggest that it's much lower than the current levels.
Greg, I'm so glad you mentioned liquidity, because I'm wondering, does something have to break in these markets, whether it's from the BOJ and JGBs, whether it's in the U.S. equity market and simply getting those trades, that liquidity that you were just talking about? Does something have to break for this market to turn around?
Yeah, well, in the end, if you look at all bottoms in bear markets and in economies, the Fed has to turn, right? And so what does the Fed have to achieve to turn? The Fed has to start bringing inflation down. Now, if they're serious about their inflation target, we don't think they'll end up being that. But if they are, they're going to have to tighten enough to bring inflation that's sticky and secular because of the change in globalization, and the change in the labor corporate relationships. There's a big secular change in inflation that's likely to keep it higher than the Fed target. If they're serious about 2% inflation, they're going to have to crack the U.S. economy hard. And it's then going to take the easing to offset that, and then the recovery before you see a bottom. So that's a long process. In the end, we think the Fed will blink and choose to sustain asset prices lower than they are today, but higher than they'd go if they actually tried to target 2% inflation. So that's going to be the yin and the yang, is how much pain the Fed is, the central banks are willing to put the economy in order to achieve their inflation targets. And they're now stuck.
Okay,
this is so different than the last.
Let's try and quantify some of this, Greg. Where, if we get, say, down, if the Fed's willing to tolerate, let's call it 3% inflation, where does that put the S&P? Can we just try and put some numbers on this in terms of where you think ultimately, how much more downside risk there is in some of these assets?
I think to get down to 3% inflation is going to require still further Fed moves, that you'd likely get short rates around 4%. Now, this is super rough, which is something in line with what's priced in. But I'd expect 10 years probably to have to go to about 4, and equity markets to come off 20% from here. So a very deep bear market, because you don't have the support of the central bank. All the last 4 bear markets that we've had, the central bank has stepped in very quickly because they weren't fighting inflation simultaneously. So you have to look at more of the sustained bear markets of periods where you have inflation that's sticky and a weakening economy. And that's kind of the worst possible world for financial assets. It's a world we haven't had, obviously, in 40 years. And it's likely the sustained world that we're in.
Greg, you mentioned the Fed. Let's talk about the BOJ. That decision coming overnight. Some people saying perhaps this is the moment that the JGB market breaks. A popular trade right now seems to be shorting JGBs. Your take on that trade, is it something you advise?
Well, it's not. It's a very difficult situation. All central banks are in a difficult situation. The BOJ is in a unique one in the sense that they're trying to hold a peg. The markets obviously don't think they can hold. They're forced to print a lot of money to offset the market move. Now, if you look at the conditions in Japan, they have the ammunition to do this if they choose to. They can print money to buy those bonds. Speculators are small relative to the BOJ's firepower. Inflation in Japan is still low. So they definitely have a different set of conditions than if you think about the U.S. or Europe. And I think the central bank is intending to do it, and that they're unlikely to be forced out by speculators. And again, this is not like a currency peg where you run out of dollars. They have plenty of yen to maintain the interest rate they want. So really the big question is, will inflation turn enough to change BOJ policy in a significant way? That's a real debate within Bridgewater. A lot of people have different views on that. I personally am concerned that global inflation will creep into Japan. The BOJ will be forced to move, but I'm pretty confident they'll move on their own timeline and that they won't be bullied into this move, and they have plenty of firepower to prevent it.
Okay, so just in terms of positioning at Bridgewater, it sounds like you're still having a fairly active debate on this. Have you positioned for such a move? Are you short JGBs yet? We've got a big meeting coming up tomorrow. Give me a sense of the timeline that you're thinking about and how you would position around that timeline.
Well, I will get into our positionings. I think the bigger things in the world to be positioned for is the fact that the markets still haven't come to grips with how deep an economic slowdown we're about to get into, how difficult it is going to be as this liquidity hole continues, and that money that private sector is going to have to sell assets to buy different kinds of assets, and that problem is probably the biggest macro thing going on. In terms of Japan, I'd say we often want to do, we want to be balanced to the two situations. They might break that peg. They might feel the need to break the JGB peg, and that has a certain set of reactions. And then if they don't break the peg and they print money in order to sustain it, you'll have a totally different set of reactions. So we try to create a balanced portfolio to those two things. There's certainly a lot of pressure in Japan. That pressure could leak out in terms of a lot of printed money to hold the interest rates way lower than market interest rates across the world, which has one set of results, and another set of results is they give up and they let rates go. And so if you can have a balanced mix of those things that could do well given that pressure, that's how we try to structure a view on Japan.
Greg, there's a headline on the Bloomberg right now. Bridgewater builds $5.7 billion bet against European stocks. There's names like ASML and Total on the list. We've been through some of the filings to take a look at what you guys are up to. Can you just talk to me about the logic behind that position? What is the objective in being so short Europe right now?
Well, I'm not going to comment on individual positions. We have positions all over the world, and a lot of times they're hedged in different ways. So the press reports are often misleading. But the basic picture that if you take Europe and the US, of this really deepening stagflation environment, this move away, rightfully move away from quantitative easing, but assets have been suspended and in suspended animation relative to the fundamentals because of the constant flow of liquidity from central banks. That has all changed. And that the adjustment that feels abrupt is small relative to how much assets have rallied compared to the cash flows over the last decade due to quantitative easing. So if you think that cash flows need to get in line roughly with the cash flows that support them and that they're not going to be supported by ongoing central bank purchases, you still have very big moves in financial assets in Europe and in the US. And that's what we, that's what we see, and our positions are essentially to protect ourselves from that type of environment, diversified across many countries in a lot of different markets.
That protection that I think a lot of hedge funds investors across the board are looking for, specifically in the dollar here. Interest rate differentials, a haven bid, a trade story as well. I have to ask, though, what turns that dollar strength story around, in your opinion?
Yeah, well, we think you're in kind of a dollar blow-off phase here. The U.S. dollar is quite vulnerable on a secular basis because the current valuation is extremely high. The reason the money is being attracted is essentially short-term flows associated with that interest rate differential. When the economy does crack in the U.S. and the Fed pivots, maybe 18 months from now or so when the Fed will be able to pivot, we think you're going to be in for a long bear market in bonds. But as long as there's a debt crunch to a certain degree and a liquidity story, the U.S. will attract a lot of capital. Now, given the degree of the current account balance in the U.S., the dollar needs a tremendous amount of capital. So even a slight change in the amount of capital the U.S. is able to attract will lead to a decline in the dollar. So right now, there's still short-term pressures bullish on the dollar, but the longer-term pressures are quite bearish. And we think you're in for a secular bear market in the dollar once you get past the speed of the Fed, the current speed of the Fed tightening.
Greg, talking of money, is cash still trash?
Well, on a secular basis, we think so. I mean, this is really the big question for the central bank. What are they going to choose, right? So this year, obviously, cash has been one of the best assets. And we've been positioned for that because cash is trash, but bonds are trash and equities are trash. So relative to goods, cash has been very bad. Relative to other financial assets, cash has been, quite good because of the dynamics that I've described. And on an ongoing basis, I think you still have that. And the question of how good cash will be relative to other financial assets really comes down to what central banks try to target. If they actually target their inflation targets, then their cash is going to be particularly attractive. They've got to really cut the money supply in order to achieve that. They've really got to drive cash up relative to everything else. So that's one possible world. Another possible world is they accept that this secular situation, the 2% inflation target, is too painful. They allow for a higher inflation target. Asset prices go down in real terms, but not as much in nominal terms. And that's another choice that they have. And of course, in that world, cash will be more trashy than in the world that they actually do what's necessary to move back to those inflation targets.
Greg Jensen, we thank you as always for your time. We wish we had more time with you, of Bridgewater Associates Co-Chief Investment Officer. Thank you as always. Still ahead, live from the Super Return Conference in Berlin, Orlando Bravo, Thoma Bravo, co-founder and managing partner. That conversation next. This is Bloomberg.
great questions.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Fast food giant McDonald's has agreed to pay $1.3 billion or 1.25 billion euros to settle probes in France. The Big Mac maker was accused of dodging taxes by unfairly shifting revenue to Luxembourg and Switzerland. The settlement still needs to be approved by the Paris judge. Under the terms of the deal, McDonald's would not plead guilty. And the biggest toy maker in the world is making plans to open its first factory in the United States. Lego will invest $1 billion to tap into rising demand in the Americas. The Danish company says the plant will be based in Virginia and designed as carbon neutral. It will employ nearly 1,800 people. Operations are set to begin in 2025. And cosmetics giant Revlon has filed for Chapter 11 bankruptcy. The company, owned by billionaire Ron Perelman, is unable to manage its heavy debt load amid the supply chain crunch and steep inflation. Revlon has failed to keep pace with rivals L'Oreal and Estee Lauder, as well as upstart makeup and personal care brands that have seen massive growth online. Revlon listed assets totaling $2.3 billion and total debts of $3.7 billion. And that is your latest business flash, Guy.
Great, thank you very much indeed. Coming up live from the Super Return Conference in Berlin, we're going to be talking to Orlando Bravo, Thoma Bravo's co-founder and managing partner. That conversation next. This is Bloomberg.
About that all day yesterday.
Busy morning, busy day. Let's go to Berlin now. The Super Return Conference back on in Berlin. Bloomberg's Danny Berger is there with Orlando Bravo, co-founder, of course, of Thoma Bravo. Danny, take it away.
Guy, thanks so much. Really excited for this conversation. Orlando, thanks so much for joining. Of course, you're joining in a moment where tech has now gone into a bear market and public market. There feels like there's this upheaval. In the world of private tech companies, is this also an upheaval?
Well, first of all, thank you for having me. I love being here. Right before we started, the person that partnered with me on the first software deal we did 22 years ago came to say hi.
Yeah,
so
in-person networking is back.
It is just absolutely awesome. Look, there are two very different worlds right now. There's the world of public software, which is mainly unprofitable. It has been unprofitable for 22 years. Some great companies, some great innovators, and in that world, investors are
equity industry in tech done a good job of this as well?
The buyout industry, the control buyout industry has done a great job.
Okay.
We have some great peers, and when you look at the performance of those companies overall in the industry, it's really great. There's accountability, there's alignment between management and one owner. There is a plan that needs to be met. The plan doesn't change because people are consistent in why they went into the deal in the first place.
I do have to ask while you're here, I do have to ask about Anaplan. You know, you get a discount on this deal, there's some issues with the covenant, and there's been some criticism about it. You know, is it because tech sold off? Are you concerned about any sort of reputational fallout from it?
Not at all, and I'm glad you really asked about Anaplan. We have been doing take-private transactions for 22 years. I can't even count how many we've done. At no time in our history have we ever backed out of a deal. Even during the global financial crisis, when buyout groups were backing out of deals because of the lack of financing, we closed our deals. Now, we have also been providing, in the process, big premiums to these companies, which means that then we have to earn a return for our own shareholders, which are our limited partners, through great operations. That's what we call we have to earn it. It's not like we're buying cheap to sell a little bit higher. It's we have to create that EBITDA. We create it through operations. Now, in the case of Anaplan, think about our LPs. These are public pension plans, most of them. These are pensioners. I have a deal, and I sign up to a contract, and I hold up my end of the bargain. And the company needs to hold up their end of the bargain. In this particular case, there was an issue. Are we, as representatives and fiduciaries of pensioners, are we supposed to look away and say, well, that's okay? Or are we supposed to address it as reputable, good people? And we did. And we collaborated with management and the board, and we got to a resolution.
Valuations fell. There's just no truth to that, but that's not why.
There was an issue which is disclosed, and I don't want to get into the specifics of that because that's in the public disclosure.
Okay, fair enough. Gotta jump in here.
Orlando, thanks for the time today. Really appreciate it. We were just talking to Greg Jensen over at Bridgewater. He sounds pretty pessimistic. Let me ask you the macro question. Are we heading for a recession? Is the Fed going to break the U.S. economy? What is your macro view of the world right now?
It is impossible to predict the macro over the long term. I just want to say that. There's a lot of talk of that, and it makes some people sound really smart, but it is impossible. What we do is I can tell you how things look today and maybe extrapolate a bit, okay? How things look today, and maybe I'm stating the obvious because we're living today. Inflation is out of control. We knew that was going to be the case after this kind of relief package. The Fed has very little control of that, and they're doing the best they can. Maybe they acted a little too little and a little too late, but now they seem to be doing the best they can, and their tools are limited given the size of the package. Now, is this going to tip us into a recession? We always plan for the worst. We say in terms of turmoil, think about being overly conservative rather than overly optimistic, and operate your companies that way. And that is what we're doing. Right now, what we see is we see some weakness in the selling environment in Europe. We see North America still strong, including the small businesses, but we're watching that weekly. And once again, we plan for the worst.
And in terms of where you see the opportunity globally, where is it? Or are you, as you say, planning for the worst? Do you see yourself spending more money in the United States? Do you see yourself spending more money in Europe? Where is the opportunity geographically?
We feel that the opportunity to buy high-quality software, which software gets hit the hardest every time there's an economic dislocation. 2000, dot-com bubble burst. Software way underperformed the indices. Global financial crisis, that was a debt crisis. Same thing. Beginning of the pandemic, Q1 2020, software way down below the other indices, below the other industries. Right now you're seeing the same. The opportunity to buy the best high quality software company that's growing. If you can own the whole company so you can turn it profitable, that is the best opportunity we've ever seen in the 22 years we've been doing this.
Orlando, it's great to catch up. Thanks for spending so much time with us today. We really appreciate what you've done. It's nice to see exactly what is happening in your space. And of course, our huge thanks to Danny Berger, Orlando Bravo, Thoma Bravo founder and managing partner, Kriti.
Yeah, Guy, fascinating couple of guests. Let's get back to the markets here, though. A lot of red on the screen. We're about an hour into the U.S. trading session. Let's get to Bloomberg's Abigail Doolittle, who is tracking the moves. Abby.
Hey, Kriti. Well, lots of red on the screen, but also a bit of a round trip here. This is an interesting chart to take a look at, a two-day chart of the NASDAQ 100 futures, and you can see into the Fed kind of flat, and then on Fed Chair Jay Powell's comments about the idea that don't get used to 75 BIP hikes, you can see this big rally that we had, giving it back. The question is, will we come back to even? A lot of times around these Fed meetings, the initial reaction is not the right reaction. You have the opposite reaction, such as we have now, and then the initial reaction can come back. Let's see whether or not that happens. One reason that it could potentially come back is a weaker dollar, but this is weighing right now in a big way the chip sector, the technology sector on the markets. The SOX is down 5.1% on fears around a recession. Of course, yesterday, the 10-30 yield curve inverted for the first time since 2006, really speaking about a super hot economy hitting a cooler economy, that idea of a recession. So this, of course, the most minute components of everything we use today down larger. However, one reason to think that maybe we're going to see, relative to the market reaction in the near term, maybe a little bit of the reaction we had yesterday. The dollar is down for a second day, down, I think, the most in more than a month. This chart here shows you the inverse relationship. So this is the dollar climbing over the last year, really pressuring risk assets. Here, the S&P 500 and Bitcoin, but you can see the dollar coming off of its peak. There's reason to think that the DXY, that dollar index, could go to 102, 100. If that happens and this inverse relationship holds, you could see a little bit of a relief rally, at least in the near term, for risk assets. Let's see whether or not that happens. That's certainly what was happening yesterday after the Fed meeting. And then finally, another reason for investors to potentially cheer, at least in the near term. Take a look at oil over the last 6 days, the worst 6 days for oil going back to March or April of this year, down 6% at 114. That, of course, is good news potentially for consumers too, if it can trickle through to the price of gasoline and other oil products that we use, guys. So lots of interesting signals to take a look at in the face of the Fed, the BOE, and so much else going on.
Great stuff, Abigail. Plenty to digest today, plenty to work our way through. Mortgage rates, a huge story right now, skyrocketing, surging to 5.78%. That's the biggest jump in 35 years. The Fed Chair, Jay Powell, talking about his outlook on the housing market at the FOMC press briefing yesterday afternoon.
If you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels.
Get some more insight into what is happening with the housing market. Scott Lawler, CEO of Waypoint, joins us now. That's a multifamily property developer in the southern region of the United States, Florida, etc. Great to have you on the show, Scott. Let's talk a little bit about what is happening here. The mortgage rate has rocketed. We're now circa 6%. What impact is that having?
Well, it's important to remember we're in the rental housing business, and so that does make it tougher for folks to buy a house in the short run. And so whether folks have concerns about a recession or whether they're looking at a higher cost to borrow, that has implications for someone's ability and willingness to go buy a home, which has implications, therefore, for rental demand. So while it's tough from certain perspectives as it relates to rental housing around our region of the country, the implications are a little different. In some ways, it might work to our favor.
Scott, we have to talk about these mortgage rates. Sure, they're rising, but at what point do we start to see the demand destruction that I think a lot of people have been calling for? But ultimately, this is a sector, this is an industry where there is still a housing shortage. When do we see that breaking point?
Well, see, it's an interesting question because, obviously the home price appreciation we've observed the last few years is not sustainable. And I don't think anybody was rooting for, 20% annual gains to continue or thought they could. But I think a very, very important distinction we have to keep in mind is the run-up we've observed, the last couple of years is very, very different than the run-up 15 or so years ago, which was heavily fueled by financing, right? We're living in an aberrational moment in time as it relates to folks with, remember ninja loans, no income, no jobs, whatever, and you go by 95% of your purchase price. That's not been what's driving things the last few years. What's been driving things the last few years is just fundamental supply and demand dynamics, which have been very, very favorable, as it relates to home values. So it's very important to keep that in mind. But, a little bit of a, people use the word reset. I don't know what the right word is, but that pausing a little is, I don't think bad at all. In fact, it might be a good thing for the economy more broadly. So where should it settle? That's hard to say, and I'm not sure we get to pick. But if we're looking at, and also it's important to keep in mind, right, the difference between declines